Part 1. There are moments in history when a single figure, quietly working behind polished doors and mahogany desks, shapes the fate of millions without leaving a fingerprint behind. Moments when power doesn't wear a crown, or a uniform, or even a recognizable face, but speaks through interest rates, monetary policy, and the confidence of markets that believe the world will continue turning simply because one man says it will. This is the story of a man often celebrated as the guardian of American prosperity, and criticized as one of the hidden architects behind some of the greatest financial collapses in modern memory, Alan Greenspan. For nearly 2 decades, Greenspan sat atop the United States Federal Reserve, the most powerful economic institution in the world, quietly steering the American and global economies from beneath the surface. He was admired, praised, trusted, even revered. Newspapers called him the Maestro. Investors treated his words like divine prophecy. Politicians looked to him for reassurance. Entire economies leaned on his tone, his subtle gestures, his carefully measured sentences. Yet, behind this aura of financial wisdom and quiet authority, there was another truth, one that would only become clear after the damage was already done. A truth that would reveal how unchecked belief in free markets, limitless credit, and speculative growth could lead not to prosperity, but to collapse. To understand how this happened, how one man's theories influenced decades of decisions affecting housing markets, banks, industries, and retirement accounts, we must go back before the praise, before the power, before the legacy, to the beginning. Part 1. Foundations of a Financial Philosopher. Alan Greenspan was born on March 6, 1926, in New York City. His early life did not hint at global influence. He was a quiet child, introspective, observant, most comfortable with numbers and patterns. He grew up in Manhattan, a place where money was not just currency, but identity. A city where the difference between wealth and poverty could be seen from one street corner to the next. Greenspan's parents divorced when he was young. He was raised primarily by his mother in a modest home, surrounded by the noise and ambition of New York economic life. The markets were not simply abstract systems, they were the pulse of the city around him. His father, a stock market analyst and writer, introduced him early to the idea that financial systems had the power to shape human lives. By high school, Greenspan had shown extraordinary aptitude in mathematics and statistics. Numbers were not confusing or chaotic. They were elegant, predictable, even comforting. When others saw risk, Greenspan saw patterns. When others saw complexity, he saw structure. At 19, he enrolled at New York University to study economics. The timing was significant. The world was shifting in the aftermath of the Great Depression and World War II. Economists were still struggling to understand how governments could prevent mass economic collapse, how to stabilize markets, control inflation, and avoid the chaos that had devastated millions just a decade earlier. This was a world trying to rebuild order, but Greenspan would eventually believe something very different. That markets didn't need order, that they could regulate themselves, that government interference was the real danger. This belief would become the foundation of his influence, and decades later, a central point of criticism. But the seeds of that belief came from one man, a writer, a philosopher, and perhaps the most controversial individual in modern economic thought, Ayn Rand, the architect of his ideology. In the early 1950s, Greenspan was introduced to Ayn Rand through mutual acquaintances in New York intellectual circles. Rand, the Russian-American novelist and philosopher, had just published Atlas Shrugged, a book that championed radical individualism and free market capitalism as the highest moral good. In Rand's view, government interference was not just inefficient, it was immoral. The market, she argued, would achieve perfection if left entirely to the forces of self-interest. To many, her ideas were extreme, unrealistic, and even dangerous. But to Alan Greenspan, they felt like truth. He joined Rand's inner circle, a group known simply as the Collective. They met in living rooms, private studies, and quiet apartments across Manhattan. These gatherings were not casual social events. They were ideological training grounds. Participants debated philosophy, ethics, economics, and the role of government in human life. Rand believed that free markets were rational and self-correcting. Greenspan adopted this belief with profound conviction. This would later become the philosophical backbone of his leadership of the Federal Reserve. Greenspan did not seek charismatic power or political spotlight. He pursued influence through the quiet structures of economic theory. To him, perfection was possible. Markets, if left alone, would always move toward equilibrium. Speculation, innovation, growth, collapse, all were natural expressions of human self-interest. Government, in his view, distorted this process. This belief was elegant, it was logical, it was compelling, but it would eventually collide with reality. The same reality that markets are driven not only by rational decisions, but by fear, greed, euphoria, and panic. And when those forces collide unchecked, the result is not equilibrium. It is crisis. Ascent to power. By the 1960s and 1970s, Greenspan had become a highly respected private economic consultant. He advised corporations, investment firms, and political leaders. His reputation grew not because of emotional persuasion, but because of his ability to speak the language of the powerful. Numbers. He understood financial systems deeply, and more importantly, he understood how to make others believe in them. In 1974, Greenspan was appointed chairman of the Council of Economic Advisors under President Gerald Ford. This was his first major political role. Here, he began to influence national policy at the federal level, and he gained something essential to his later authority: trust. He did not appear ideological, he appeared intelligent, competent, stable. He was a man who could make chaos seem manageable. In 1987, during the presidency of Ronald Reagan, Greenspan was appointed chairman of the Federal Reserve. This role would give him extraordinary influence over interest rates, banking regulation, the housing market, and the overall direction of the U.S. economy. He stepped into the position at a pivotal moment, because just 2 months after he assumed office, the markets collapsed. The first test, Black Monday, October 19, 1987, a day that would become known as Black Monday. The Dow Jones Industrial Average fell more than 22% in a single day, the largest one-day percentage drop in U.S. stock market history. Billions of dollars vanished. Panic swept through global markets. Investors feared that this was the beginning of another Great Depression, and all eyes turned to the new chairman of the Federal Reserve. Alan Greenspan had been in office for only 8 weeks. He needed to act carefully. If he responded too aggressively, he risked destabilizing confidence. If he did nothing, the collapse could spread. So he made a statement, a calm, controlled, calculated declaration. The Federal Reserve, he said, would supply the necessary liquidity to support the financial system. He did not promise rescue. He did not promise intervention. He simply said the Federal Reserve would ensure stability. It was enough. The panic slowed. Markets leveled, confidence returned, and Greenspan's reputation was born. He was the man who could calm storms, the one voice the markets listened to, the Maestro, the illusion of control. For the next 2 decades, the United States experienced sustained economic growth. Productivity increased, inflation remained low, unemployment fell. To many, this was proof that Greenspan's philosophy of minimal regulation was working. But beneath the surface, something else was happening. Low interest rates fed borrowing. Borrowing encouraged speculation. Speculation inflated asset prices. Markets surged, not because of sustainable growth, but because of cheap credit and rising leverage. Home ownership increased, but so did mortgage debt. Stock prices rose, but so did margin borrowing. Banks expanded, but they also took greater risks. Greenspan believed that markets, left alone, would correct themselves. But markets are not perfect. They are emotional. They are fragile. They are human. And when confidence is built on illusion rather than foundation, the collapse is not a matter of if, but when. This is where the seeds of crisis began. Not in the 2000s, not in the housing bubble, not in the collapse of Lehman Brothers, but here, in the quiet, confident decades when everyone believed that the system was stable because one man said it was. The stage was set. The players were in motion, and the world was heading toward a financial reckoning. Part 2. The United States entered the 1990s confident. The Cold War was ending, globalization was accelerating, technology was advancing faster than the world could understand it. A new era of prosperity appeared not just possible, but inevitable. And standing quietly in the center of this transformation was Alan Greenspan. He had become more than a policymaker. He was a symbol, a reassurance, a living guarantee that markets would continue to rise and crises would remain contained. Investors watched his expressions, journalists studied his phrasing, politicians crafted budgets around what they expected him to do. The world did not simply trust Greenspan, it depended on him. But dependence, especially when invisible, can be dangerous. Because when belief becomes a foundation, truth no longer matters, only perception. This was the economic environment of the 1990s. Growth built on belief, confidence built on reputation, markets built on expectations rather than reality. And in that environment, a storm was forming. A new economy emerges. The internet did more than connect computers. It connected desire. The promise was intoxicating. A digital marketplace, global communication, unlimited innovation. Companies that had never earned a dollar were suddenly valued at billions. Venture capital poured into startups at a pace that defied reason. It was not business anymore. It was a gold rush. The dot-com era, websites, ideas, brands, promises, all were treated as assets. The world believed it was witnessing the birth of a new economic system where traditional metrics no longer applied. Profits were outdated. Stability was irrelevant. The only thing that mattered was growth, and growth was limitless. Markets soared, investors celebrated, and Greenspan watched carefully. But unlike the public, he saw the danger. In 1996, during a speech to the American Enterprise Institute, Greenspan introduced a phrase that would echo across history: irrational exuberance. He warned that markets were becoming seduced by optimism, that prices were rising not because of real value, but because people believed they would continue rising. It was a cautious warning, subtle, almost poetic, but it was ignored. Investors heard what they wanted to hear, that the Maestro was still conducting the symphony, and so the music continued. Markets climbed, risk became entertainment, debt became fuel. The Federal Reserve under Greenspan kept interest rates low. The cost of borrowing was cheap, capital flowed freely, and the bubble expanded. If markets were rational, as Greenspan believed, they would eventually clear out the excess on their own. But markets are rarely rational. They are emotional. Hope swells faster than reality can catch it. In March 2000, reality caught up. The dot-com collapse, the NASDAQ composite, once the symbol of unstoppable technological expansion, began to fall, slowly at first, then violently. In a matter of months, trillions of dollars in market value evaporated. Companies that had been celebrated as the future disappeared overnight. Retirement accounts shrank, fortunes dissolved. The economy slipped toward recession. And once again, the world turned to Alan Greenspan. Investors asked, would the Maestro intervene? Would he rescue the system again? And he did. The Federal Reserve lowered interest rates. Money became cheaper. Liquidity flooded the markets. The recession cooled. Confidence returned. It was another victory for Greenspan. Another demonstration of his ability to prevent catastrophe. But victories have consequences, because every rescue creates dependence, every bailout discourages caution, every intervention signals that risk no longer carries consequences. If markets believed they could not lose, they would gamble everything. And they did. Deregulation, a system without guardrails. While the dot-com bubble rose and fell, a quieter, more significant transformation was occurring behind the scenes, one that would alter the structure of the global financial system. Deregulation. To Greenspan, regulation represented interference, a barrier to natural market equilibrium. Banks, investors, and corporations, he believed, would act responsibly in their own self-interest. They did not need restrictions. They needed freedom. This belief shaped key decisions. In 1999, the Glass-Steagall Act, a law from the Great Depression separating commercial banks, which handle deposits, from investment banks, which take risks, was repealed. This allowed banks to merge into financial superstructures, enormous institutions that could lend, speculate, insure, and trade all under one roof. This was the beginning of the too-big-to-fail era. Greenspan supported the repeal. He believed larger financial institutions would be more stable, more efficient, more capable of managing risk. But something else happened. When banks grew, so did their power. When their power grew, so did their appetite for profit. And profit required risk. The system now had no guardrails. To Greenspan, this was not a flaw. It was design. To markets, it was an invitation. The rise of subprime lending, low interest rates made borrowing attractive. Home ownership became a national goal. Banks began offering mortgages to people who once would have been denied. Borrowers with low credit scores, uncertain income, unstable employment. These were called subprime loans. On the surface, the system appeared generous, a path for ordinary families to achieve the American dream. But beneath this dream lay a growing instability. Lenders were not simply offering loans, they were packaging them. Mortgages were bundled into financial products called mortgage-backed securities, which were then sold to investors around the world. The logic was simple. More loans meant more securities. More securities meant more profits. Wall Street demanded more mortgages. Banks supplied them, regardless of quality. Applications were approved without verification. Interest rates were set to rise sharply after introductory periods. Borrowers were assured that housing prices would always go up. Greenspan believed this expansion of credit was beneficial, a natural expression of a free market. He praised adjustable-rate mortgages as financially efficient. He dismissed concerns about risky lending practices. The system continued to grow. But a house of cards does not collapse when it is built. It collapses when the wind changes. The wind was already shifting. Warnings in the dark. By the early 2000s, a handful of economists, analysts, and financial journalists began to sound alarms. Housing prices were rising far faster than income. Debt-to-income ratios were climbing. Mortgage defaults were increasing. The financial system was becoming dangerously leveraged. They saw instability. They saw risk. But Alan Greenspan did not. Not because he could not, but because he believed he should not. To acknowledge danger would require intervention, and intervention would violate the core of his ideology. Greenspan had built his career on a single premise, that markets are self-correcting. But self-correction requires pain, and the world had grown accustomed to comfort. Every crisis had been rescued, every downturn softened, every bubble reflated. The system had no memory of failure, and without memory, it had no caution. The seeds of collapse. In 2004, the Federal Reserve began to raise interest rates, slowly, predictably, carefully. But the impact was immediate. Adjustable mortgage rates increased, monthly payments rose, borrowers began to struggle, defaults began to grow. Housing prices, once believed to rise forever, started to plateau, then fall. The structure built on leverage, debt, speculation, and belief began to reveal its cracks. But the financial system was now so interconnected that a single crack did not remain a crack. It spread. Mortgage lenders could no longer sell their loans. Banks could no longer offload their securities. Investors began to question the value of assets that had once seemed unquestionably safe. Like the dot-com bubble before it, confidence, the invisible foundation, evaporated. But this time, the scale was not limited to tech companies or stock portfolios. This time, the foundation was the homes people lived in. The collapse had already begun. The final act of the Maestro. In January 2006, after nearly 2 decades at the Federal Reserve, Alan Greenspan stepped down. He left office as one of the most celebrated public officials in American history. He was praised as the guardian of prosperity, the architect of stability, the master who had tamed inflation, prevented recession, and guided the world economy. His term ended quietly, with applause. But the applause came before the reckoning. Within months, the financial system began to unravel. The cracks widened, the pressure increased, the structure buckled. The world was heading toward the largest economic collapse since the Great Depression. A collapse rooted not in accident, not in chance, not in unforeseen circumstance, but in belief. Belief in markets that could not fail. Belief in systems that could not break. Belief in a man who had been trusted with too much. And so we arrive at the final chapter, the collapse and the reckoning that followed. Part 3. The warnings were no longer whispers. They were numbers, cold, sharp, undeniable. By late 2006, default rates on subprime mortgages were rising faster than any model had predicted. Once eager and thriving, mortgage lenders now found themselves holding loans that could not be paid. The first failures appeared small. A lender here, a hedge fund there. But the signs were unmistakable. Something foundational was failing. For years, the system had been underwritten by the belief that housing prices would always go up. This belief had been profitable, consistent, comforting, and it had been dangerous, because when a system depends on constant growth, even the smallest decline becomes catastrophic. Housing prices did not need to collapse to trigger a crisis. They only needed to stop rising, and they had. What followed was not a single crash, but a chain reaction. A slow unspooling of assumptions, confidence, and debt. It was a crisis built not of a single failure, but of countless decisions made under the illusion that the system was safe because Alan Greenspan believed it was. The collapse began in silence. Then it roared. The unraveling. In 2007, Bear Stearns, one of the largest and oldest investment banks in the United States, found itself collapsing under the weight of mortgage-backed securities that were, effectively, worthless. Its internal models had assumed stability. Its traders had assumed growth. Its executives had assumed safety. But assumptions have no value in reality. The fall of Bear Stearns was a shock, not because its failure was unimaginable, but because it revealed the fragility of the entire financial system. If one institution could fall, others could follow, and they did. Lehman Brothers, Merrill Lynch, Washington Mutual, Countrywide Financial. These were not small companies. They were pillars, the great houses of American finance, and they were crumbling. The crisis exposed something fundamental. Confidence was not merely part of the financial system, it was the system. And confidence had now collapsed. The markets froze, credit markets seized, banks stopped lending, corporations halted investment, consumers stopped spending. Fear, not interest rates, not monetary policy, not political promises, now controlled the American economy. The global financial system began to fail. The world reacts countries across Europe and Asia, tied to the American housing market through investments, securities, and global banking networks, felt the shock. Iceland's banking system collapsed. European institutions required emergency nationalization. Debt markets evaporated. This was no longer an American crisis. It was global. Leaders met in emergency summits. Central banks injected capital into markets. Governments issued guarantees. Economists spoke on television with uncertainty that bordered on fear. The system was not only malfunctioning, it was unwinding. And yet, through all of this, one question prevailed. How did this happen? How had the world's most sophisticated financial system, backed by centuries of economic theory, regulation, and experience, permitted such risk, such exposure, such blindness? The answer increasingly pointed not to chance, but to belief. The belief that markets could self-regulate. The belief that innovation was always progress. The belief that risk did not require restraint. The belief championed by Alan Greenspan. A reckoning in Washington. In October 2008, Alan Greenspan appeared before the U.S. Congress to testify on the causes of the financial crisis. The man who had once been treated as a financial oracle was now being questioned, publicly, directly, and without reverence. The hearing was tense, serious, historical. Members of Congress asked Greenspan to explain how the system he had overseen for nearly 2 decades had failed so profoundly. They asked why he had dismissed warnings about predatory lending, excessive leverage, and unregulated derivatives. They asked whether he still believed that financial markets could regulate themselves. Greenspan's response was quiet, measured, but revealing. He admitted, for the first time, that his core assumption had been wrong. "I found a flaw," he said. "A flaw in the model that I perceived as the critical structure that defines how the world works." That flaw had not been small, it had been catastrophic. The flaw was the belief that financial institutions, driven by self-interest, would naturally protect both themselves and the broader system. But self-interest does not create stability. It creates profit, and profit without restraint creates collapse. Greenspan had believed in the rationality of markets, yet markets had shown themselves to be anything but rational. He had believed that risk would be managed, yet risk had been hidden, multiplied, and sold as if it did not exist. He had believed that the economy was stable, yet stability had been an illusion, maintained only by borrowing and speculation. In his testimony, Greenspan did not express remorse, not emotion, not regret. He acknowledged miscalculation, but the consequences of that miscalculation were already indelible. Millions of jobs lost, millions of homes foreclosed, millions of retirement accounts destroyed, decades of accumulated wealth erased. This was more than a financial correction. It was a societal wound. The legacy reconsidered. For much of his career, Alan Greenspan was celebrated as the man who had guided America through growth, innovation, and prosperity. He had been hailed as the architect of stability, the guardian of the economy, the maestro whose judgment could be trusted without question. But history does not measure legacies by praise earned during prosperity. It measures them by the consequences of decisions made when no one believed they could fail. Greenspan had not caused the crisis alone, but he had enabled it. He had encouraged it. He had defended the philosophy that allowed it to spread. Deregulation allowed banks to gamble. Low interest rates encouraged speculation. The belief in self-regulating markets allowed risk to accumulate unchecked. This was the architecture of collapse, and it was an architecture shaped in large part by him. The system that remains. Even after the crisis, many of the structures that fueled it remain in place. The financial system is larger than before. Corporations are more consolidated. The global economy is more interconnected. Debt loads are higher, market speculation is faster, algorithmic, and more abstract. Regulations have been introduced, debated, weakened, revised, and challenged. But the core question remains: have we learned? Or have we simply rebuilt the same structure with new names and new language, waiting for the next collapse? History rarely repeats itself exactly, but it does echo. Final reflection. Alan Greenspan did not set out to harm. He did not seek collapse. He was not a villain in the traditional sense. He was a man who believed in a model of the world, a model elegant in theory, but fragile in practice. A model that worked when times were calm, but shattered when tested by human emotion. His legacy is not simply one of failure, it is one of caution. A reminder that stability without scrutiny is illusion, growth without restraint is danger, and trust without accountability is risk. The story of Alan Greenspan is the story of power unseen, the kind that does not command armies or write laws, but shapes the world through assumptions so deeply held that they become invisible. The man was celebrated as a savior, then questioned as an architect of collapse. His legacy remains complex, ambitious, and unfinished. The system he helped build continues to define the world. The question that remains for us is simple. Do we continue the story as it has been written? Or do we choose to learn from the fall? The future will decide.